Jeff, I mean, the numbers were really strong today on the job market for the year, for the month, the wages up 3.2% from last year, and then Jay Powell signaled flexibility and flexibility on the balance sheet. This is a sort of, yesterday was a double whammy of bad news, today was a double dose of good news.
Well, the trade gate, if you will allow me to use that term, I think that was maybe a solution to the China trade gate situation. I think SEMA had that. You also had hedge fund selling, liquidations. About 140 hedge funds closed their doors. You had ETF liquidation. You had mutual fund redemptions, and you had tax loss selling. And there were basically no buyers around. The portfolio managers I usually talk to on a daily basis, they were gone for just about the entire month of December. So the sellers were selling into a vacuum. And that vacuum got filled up today, as a matter of fact. And usually when you get big moves like this on the upside and downside, you're either near a top or you're near a bottom. And after a near 20% decline, I think we're at a bottom.
And Dave, before we get to you, let's listen to some dovish comments from Jerome Powell this morning. Obviously, the market had been tensed up in advance of both the jobs number and Powell's public remarks. But here's some of what he said.
We will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy, should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%.
So, Dave, obviously the market came into today just saturated with this story in its head about a slowdown, about earnings warnings, buying in a panicky way Treasury bonds yesterday. And so was this from Powell enough to kind of set some of that aside for now, to at least think that the Fed's listening to the markets?
Well, I think it sounded like a guy who doesn't want to be responsible for a recession. But I think that, I talk to banks all the time. Jeff and I have known each other forever. No bank is telling me that the rate increases that have happened so far are impacting loan demand or loan quality. So the fact that the market's up or is down a lot because rates have gone up it makes no sense in the sense of what's happened, what I'm hearing out there. I'd also point out that the last time I was on with you guys was December 24th, which was the low. So I feel a little better now. But I think at the end of the day, you've got a lot of back and forth. I think a lot of people are trying to figure out what's happening. And I think the real issue for me is that there as you said, Mike, there's an earnings slowdown happening, and yet there doesn't seem to be a reason for it. It's not rates. It's not the Wall Street. It's not a Bear Stearns failure. There isn't any real big surprise. Maybe Apple was a little bit. And so I think the market's trying to figure that out. And I think the goal is to, especially near year end, was to take profits, and we'll see what happens.
Is it not the trade war, Dave, which Apple reminded us all of this week?
Well, I think what I would say is that we are no longer the only and most important economy in the world. I've been in the business for 35 years. 35 years ago, nobody else mattered but us. And I think since 2008, which was really the last big time, China now matters. And I think we're having to deal with that as a country, and as these different companies now expand and grow, and the demand in China has now grown, just what they wanted to have happen. And now that that's happened, it matters. So now we have to worry about China and the U.S. in terms of these larger companies, in terms of their demand and their profits. And that's a new equation that we have to add in. Apple is telling you that. And so now it's like, okay, well, that's a new risk or a new uncertainty or maybe a new opportunity. We'll find out.